let's say bank stocks are yielding 3.5%. That's, almost 4 times what you get in a 10-year treasury bond. Lending your money, banks are borrowing at, 1% themselves and paying out their shareholders 3.5%. You could argue that those bank stocks are really, really cheap in this environment. And people are worried about, bank profitability is going to be impacted, but they've reserved billions and billions and billions of dollars. And, maybe it's not going to be as bad as people think. So there could be a lot more upside this market. People are saying, well, the S&P might see 4,000. We're at 3,600 right now, or whatever it is, and we could see the S&P at 5,000 next year. I mean, it's not unreasonable to think that banks shouldn't trade at 18 times earnings, not 12 times earnings, and that's another 50% increase from where we are right now. It's totally possible.
You still pay your bank fees. In Toronto, and I would say in Canada, the housing market looks to be okay. So more mortgages are being issued. These banks are, yes, they've reserved, and you could probably say too much if things go well, but that's exactly it. I mean, for clients that are looking for income, where do you go? Well, bank stocks that pay 4, that are trading at let's say half the market multiple or a little bit more, look pretty compelling. I mean, one of the arguments is, where does fixed income play into a portfolio where yields are really low? Is there a place? We've heard the argument of, you don't need any more fixed income. You should just buy dividend stocks. And that's a debate that will probably go if rates are staying low, as the central banks have said, for 2 to 3 years. We might be talking about that for 2 to 3 years, but those kinds of issues are certainly at the forefront, right? And things that we're going to have to talk to clients about and have those conversations with.